Welcome back to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business in Toronto, Canada. Today we're going to talk about accounting for investments in other companies. And this is when one company buys some or all of the shares of another company. So what happens when a company owns the shares of another company? There's three things we're going to talk about. We're going to talk about a situation where a company has a controlling interest. That's the situation where a company owns between 50% and 100% of the shares of another company, and so therefore has 100% control over the company, even if it owns less than 100% of the shares because of, majority vote at the board of directors level. Then we're going to talk about a situation where a company has significant influence over another company, so less than 50% of the shares, but still a significant stake in the company and therefore a significant say in what the company does. And then we're going to talk about the situation where a company is just making a passive investment in another company. For example, Microsoft might own $1 million worth of shares in Apple. That's a very, very small portion of the overall share position of Apple, and therefore Microsoft in that circumstance might have no influence whatsoever over the workings of Apple, even though it owns some of the shares purchased on the stock market. So let's talk about those in turn. All of this is about the power problem, right? So the reason that we have different ways of accounting for different levels of investment in another company is because the investor company can exercise some degree of control over the company. And if it exercises more than 50% of the control or has significant influence over the company, it could cause that company to alter the returns on its own investment. And we don't want that to unduly influence the financial statements of the investing company. If you can, for instance, through your votes on the board of directors, cause the investee company to issue a dividend to you and basically just tell it to do so, well, if you account for that dividend as income, then you could use that influence on the other company to artificially inflate your net income based on your influence in that other company. That's a big problem. So we have to have accounting mechanisms that prevent that from happening. So a couple of hypothetical examples, purely hypothetical. Suppose that Ford buys shares in a muffler supplier, and if it owns, more than 50% of those shares, it could force the supplier to reduce its prices, which would inflate the income of Ford. And because Ford doesn't own 100% of the muffler supplier, he gets 100% of the benefit of the reduced prices, but it bears less than 100% of the cost to the shareholders of that reduced profit in the supplier. Here's the example I just spoke about, Microsoft owning shares in Apple. If it had enough shares in Apple that it could influence the decision at the board level, it might convince Apple to, say, delay the dividends until just after the Microsoft year end so that Microsoft didn't have to report that income. Well, if we take away the accounting possibility that Microsoft would record those dividends as income, then that takes care of the problem. So we're going to have to look at how accounting solves that. Let's just look at the range of levels of influence which a company might exercise. This scale from 0 to 100 is simply representing the percentage of ownership that a company has in the shares, the voting shares of another company. And that can go from full control, right, where you've got 100% of the company, in which you get full control of the company and also full financial returns out of that company. If you own between 100% and 50%, you've got full control over the company, but you only get a portion of the financial returns because a portion of the financial returns goes to those other shareholders. If you have between 50 and a tiny percentage of the shares, then you still have significant influence because you have a significant position in the company, even though you don't have majority control. Now, the degree of significance of your influence depends entirely on how the rest of the shares are distributed. If the other shares are all owned by somebody else, then your influence is quite minimal because no matter how much you squawk at the board meeting, the other shareholder has more than 50% and can simply outvote you. But if the shares of that other company are widely distributed in the stock market and everybody else has, let's say, 1% or less of the shares, and you're the only person with 10% of the shares, well, you're the largest shareholder and you have a huge say at the board meeting. So having that degree of influence, you might be able to demand that the board give you a seat on the board, for instance. And if they don't give it to you, you would use your shares at the annual general meeting to convince all the other shareholders to vote against the election of the directors, for instance. So having more than a small passive investment in the company, but less than 50% of the shares can still, in some circumstances, give you significant influence. And of course, the final case is where you own just a tiny portion of the company and you don't have any ability to influence the decisions that are made at the board level. It used to be that accounting principles stated exactly what the level of ownership was that distinguished a passive investment from a significant influence position. But now I think the accounting regulations allow the auditors to determine what constitutes significant influence and what constitutes a passive investment. And the company, in order to comply with its auditors' stipulations, will have to account for those investments in a particular way. So let's look at how the accounting is affected by these different ranges of influence. When a company is investing in another company and it has a controlling interest, so more than 50%, it is actually able to determine the policies of the company, including things like executive compensation, the election of the board of directors, and so forth, the appointment of the auditors. All of those things are decisions made at the AGM based on the voting pattern of the shareholders. And if you own more than 50% of the shares, you get to control those decisions. And of course, you probably have positions on the board to represent your shares. And even at board meetings, you have a significant ability to influence the decisions that are made by the board. So in that case, what has to happen by accounting regulation is that you have to consolidate that other company that you invested in into your financial statements to produce consolidated financial statements. We'll look at how that's done in a little bit of detail later on. If you have a significant influence position, then you have the ability to affect the decisions, even though you don't necessarily directly control them, but you have a significant effect on them. In that case, the accounting is done through the equity method, which I'll describe in a minute. And if you are in a situation where you just have a passive investment in the company, a small number of shares and no influence on board decisions, no more than any other small shareholder, then you are considered to have no direct influence on the decisions. And in that case, there's a number of options available to you that have to do with the amortized cost method or the fair value method, which I'll describe to you. A controlling interest then, when you own more than 50% of the shares of the company and control the other company, you have two legal entities. You've got the parent company and the subsidiary. Both of those are actual corporations, but that's only in the legal sense, because in the economic sense, it's considered to be one economic entity, because the parent company and the people who control that parent company determine what the subsidiary can do. And therefore, economically, it's like having one big company. So in order to represent the economic value of that conglomerate properly, you have to create consolidated statements. And that's for the overall entity, right? The parent and all of the subsidiaries in which it has more than 50% ownership. What does the consolidated balance sheet look like? Well, you combine all of the assets of the two companies, or the parent company and all its controlled subsidiaries. You combine all of those together, and that shows as the assets of the company. You combine all of the liabilities, because of course, when you own another company, you also own its liabilities. And then you have to eliminate any assets where one company owns the assets or the liabilities of the other. So for instance, if one company owes money to another, then that amount that is owed would be an asset to one company and a liability to the other. Well, we just eliminate that from the combined balance sheet because those things will cancel each other out. So for instance, if the parent company has shares listed as an investment that it's made in that subsidiary, you cannot include that investment in the subsidiary's equity, because that's actually equity that is owned by somebody else, by the parent company. And if there's a receivable from one company to another, then that would be actually a payable to the other. If there's a payable in one company to another, that would be a receivable to the other. So all of these things are intercompany assets and liabilities that have to be eliminated from the combined balance sheet. On the income statement level, you have to combine all the revenues and expenses of the company, but what you eliminate is transactions between the parent company and the subsidiary. So, if all of the sales of the subsidiary are to the parent company, and it has nobody else that it sells to, then all of those sales disappear from the consolidated income statement because they're a revenue for one company and an expense of the other. But if the subsidiary also sells to other companies outside of the parent company, then that revenue would be included in the overall income statement. Same thing with expenses. The inventory purchase, for example, is actually sales revenue of the subsidiary, so that gets eliminated. And if you have assets and there's a gain or loss, then that gets eliminated as well. If the parent company decides to sell its old factory to the subsidiary, it might record a gain or loss on its income statement. But of course, that's a price to the subsidiary, so all of that gets washed out and has to be eliminated from the combined income statement. So that's a consolidation. We are going to look at an example of that in a little more detail. But let's move to the second scenario where the company has less than 50% stake in the company, but has a significant influence over the investee. So you don't consolidate it because you don't have full control, but you do have influence over those decisions, such as when to declare dividends. And so it's more than just a passive investment. In this case, the investor accounts for the investment using the equity method rather than the consolidation method. So what does the equity method look like? Well, the disclosure by the investor is quite straightforward then. You simply have one line on your balance sheet that lists the shares of that other company. And that might be combined with other investments that the company has made. Financial assets, for instance, might be a line on the balance sheet in the asset section. So that's a single line. So rather than consolidating all of the assets line by line and consolidating all the liabilities line by line, you just have one line on the investor's balance sheet that shows this investment in the other company. Same thing goes with the income statement. Rather than consolidating the income statement on a line by line basis, you have a single line on your income statement that shows the profit that you get out of that investment. So that would be financial income. All right, so what happens if the investee company earns some money? Under the equity method, what happens is that the investee's net assets, so this is the company that the investing company owns, when it has income, of course, its net assets are going to go up because its retained earnings go up. So what should the investing company, the investor company, do? Well, the value of the investment has gone up because the equity of the company in which you invested has gone up. So, for example, if the company owns a 25% share in the other company, that's a significant influence over the company, 25%. If that company earns a $10,000 profit, then the investment of the investing company goes up by 1/4 of the $10,000, by $2,500. And that's recorded on the income statement as income from the subsidiary. So for the investor company, the company that owns the 25% stake in the other company, what you're going to see is the assets go up by $2,500, the financial investment line on the asset section. And the retained earnings are going to go up by $2,500, keeping the balance sheet in balance. And the income statement is going to record that $2,500 financial income. If the investee company, the company in which the company has purchased shares, declares a dividend, what happens? Well, what happens is that that subsidiary company, that investee company, is actually having its net assets go down because it has parted with its retained earnings, right? Its cash goes down and its retained earnings goes down when it declares a cash dividend. And the owning company, the company that owns the 25% of the shares, gets a portion of that dividend. So if the investee company declared a dividend of $1,000, the company that owns 25% of the shares gets 25% of that dividend. So what happens? Well, it does get the cash, right? So the cash of the owning company goes up by $250. And rather than declare that as income, the investment in the company goes down. So if you look at the asset side of the balance sheet of the investing company, the investor company, it will show a certain amount of cash and it'll have a value for the investment in this other company. If that other company declares a dividend, the cash of the owning company goes up and the investment asset goes down, and there's no impact on the income statement. Accounting for it in this way prevents the investing company from using its influence over the investee to declare a dividend and have it show up on the income statement. So that is preventing the possibility that the investor company could use its influence to affect its own income statement, because it goes directly from the investment line in its asset section to the cash line on its asset section without flowing through its own income statement. Now let's look at passive investment. So this is the situation where a company owns a small percentage stake in another company and has no interest in influencing that company whatsoever. It's just bought some shares on the stock market and may sell them at some point in time. So the question is, when is that point in time that it plans to sell those shares? That's what's going to determine how the company accounts for those. There's three possibilities. There's the amortized cost method, fair value, where the difference in fair value from one period to another affects the profit and loss statement, and fair value, where the difference in fair value from one period to another is simply recorded in the other comprehensive income and it doesn't go directly through the income statement. So this is the default position here. If you don't elect to do something different, then your passive investments in other companies are always going to be shown at fair value, and the difference is going to affect your own income statement. And this is fine because you don't influence the company in any other way. You're just a passive shareholder. So whatever happens to those shares is a change in the fair value of your assets. And that difference in assets has to be accounted for in the equity section, right, to keep things in balance. And the way that it will happen is you will declare an income or a loss on the change in fair value on your income statement. So that's the default position. Remember that IFRS has a focus, almost an obsessive focus on the balance sheet, and it wants those values on the balance sheet to be useful for decision makers when they look at the balance sheet. And it cares less, a little bit less, what the effect of that might be on the income statement. So with financial investments, of course, it's usually quite simple to look up the fair value of an investment. You can look it up if the company is publicly traded. It's a little more difficult if those shares are in a private company because there's no stock market to look up, and it can be costly to figure out what the fair value is. So, for instance, if you bought bonds in another company, they might have a specific time at which that bond matures. So, in that case, you can use an amortized cost method. And what that involves is basically saying we know what the value of the investment is now. We got the present value of those future cash flows, and we know what the cost is going to be or what the gain is going to be. And we're going to amortize that over time in a very methodical way. And we'll do a reconciliation at the end if there's any discrepancy, just like, if we had an asset that was going to go down in value. So that's a possibility, and a company can elect to do that. And it will do this for fixed term investments, such as investments in bonds, but it's not going to do that typically for shares that go up and down randomly in value. So that leaves the two fair value methods. And if the company knows that it's going to be hanging on to investment for a fixed period of time, then it may elect to account for those investments using fair value, but recording the difference in other comprehensive income. And what that means, for instance, if the company owns some sort of a derivative that is used to offset the fluctuation in another asset, such as foreign currency, the fair value of that derivative goes wildly up and down depending on circumstances that are beyond the control of the company. And the company doesn't want that fluctuation to be affecting the profit and loss every time it turns around. So it will elect to account for those investments at fair value, but with the difference appearing in other comprehensive income. So if it's planning on holding on to that derivative for, say, a period of 3 years, then it will elect to record the fair value on the asset section of the balance sheet. But the difference is not going to affect the income. It's only going to affect the accumulated other comprehensive income in the equity. And it's not until the company gets around to actually parting with that investment in 3 years' time that the difference between its original purchase price and the sale price would be recorded as a gain or loss on the profit and loss statement. So at that point, any accumulated other comprehensive income related to that fluctuation in fair value would be taken out of accumulated OCI and put through the profit and loss as a gain or loss, and it would then be transferred into retained earnings at the amount of the overall gain or loss over time. So, that sounds a little bit complicated, but basically what it's doing is saying that we're going to recognize the fair value of that asset every time we publish our financial statements, but we don't want the change in that fair value to be affecting our profit and loss. So we're going to park it temporarily in accumulated OCI and not recognize it as gain or loss until the final day in which we sell that asset. All right, so those are the three ways of accounting for passive investment. Um, they are actually a little bit more complicated to explain than to understand conceptually. So I encourage you to think through how these work and to look at some of the examples in the textbook in order to understand them better, because that's the kind of thing that might be an exam question. Explain the difference between these three methods, and you should be able to put it in your own words. Let's look a little more closely at the amortized cost method. This is typically used for investments in bonds, and the bonds have to meet two conditions. There's the business model test and the financial model test. The business model test is simply that the bond has to be something that the company is planning on holding to maturity. So does the company have the intention of holding on this bond until maturity? If it's not, if it's planning on the possibility of selling that investment at some point in time that suits its own purposes instead of holding on to it until maturity, then it doesn't meet that condition and it should not be accounted for at amortized cost. There's also the financial model test. So whatever this investment instrument is, if it doesn't involve fixed payments of interest, then you can't use the amortized cost method. So if both of those conditions are met, then the company should account for it using amortized cost. And then it gets treated just like property, plant, and equipment. You've got a present value, and you're going to recognize the gain or loss, the anticipated gain or loss on an amortization method. If there's an impairment of the bond for some reason, then you're going to have a write down just like you would for any other asset. And at the end of the day, if your amortization that you had laid out is not perfect and you haven't arrived at exactly the same number for the book value of the investment and the market value of the investment, then you're going to have a bit of a gain or loss. And so when you sell those bonds or receive the value of the bond back from the investee, then you're going to recognize a gain or loss at that point. The intention is to have a very methodical recognition of the gain or loss over time so that you don't have this distorting effect of fluctuations on your income statement every year. So that's the amortized cost method. A closer look at the fair value through profit and loss looks like this. Again, this is the default category. If you don't choose one of the other categories, or if you're not mandated to use one of those other categories, then you show the investment on the balance sheet at fair value, and every little change from one period to another is going to affect your profit and loss because you can have a change in fair value, or if you receive interest on the investment or dividends, all of those things are going to flow through your profit and loss. So a change in fair value is going to be a gain or a loss. And, even if you haven't sold it, that's a gain or a loss to you because the value has changed on your balance sheet. But also interest and dividends received become income and need to be disclosed on the profit and loss statement. One of the things that you might want to do is look at the possibility of using a combination of the fair value method and the amortized cost method. And this is used for non-financial assets that are valued periodically at fair value, or for investments in private companies where it's hard to determine and costly to determine the value of shares. So that those revaluation costs can be considerable if it's not a security that trades on the stock market. If you can just look up on the stock or bond market the value of the investment, your revaluation costs are trivial. But in every other case, it can be quite costly to pay a financial consultant or an actuary to go in and look at the value of those assets. So what a company might do is use the fair value every few years, like every 3 years or every 5 years. And in between those times, it will use the amortized cost method simply to save on the revaluation costs. So this is not an attempt to get around the consequences of the fair value influencing the profit and loss statement, because it will every time the fair value is determined is going to have that impact. It's simply to avoid the cost of the revaluation, which, as I say, can be substantial. The fair value through OCI, which I discussed earlier, is an option that can be elected by management. So management looks at a security that it owns or an asset that it owns and may decide that it does not want the change in fair value in there to be affecting income. And the important thing to note here is that this is an irrevocable decision. So the company is not allowed to use this for assets that are held for trading. And it's also not allowed to put one of its investments into this category of accounting and then take it back out. Because, of course, that would encourage the company to park any losses that might come through the revaluation of the asset in its accumulated OCI and then take it back out when that asset goes back up in value and record the gain on the income statement. That, of course, would be obvious manipulation. So that's why this is a one-way decision. The company can take an asset and recognize it at fair value through the profit and loss statement, and at some point in time decide, no, let's put this through OCI. And if it decides to do that, then it is there permanently until such time as the company finally sells the asset. So the investment is always going to be shown at fair value on the balance sheet, but the gains and losses do not go on the income statement. They go into accumulated other comprehensive income. So through the statement of comprehensive income and into the accumulated other comprehensive income in the equity section. But the interest or dividends that the company receives, those do go through the profit and loss. So it's only the difference in the value of the asset itself that is going to go into OCI. Now we get to look at consolidations. Consolidations are probably the most complicated thing that an accounting firm ever has to do. So we do need to look at it in a little bit of detail, but keep in mind, this is still quite a conceptual level that we're doing this at. And I'm doing it for you so that you can think about what's implied in a consolidation. I'm not trying to turn you into an expert that can do a consolidation, but I do want you to understand the concepts. So the idea here is that you've got a subsidiary of some kind. Now, oftentimes a subsidiary, in fact, most of the subsidiaries that exist in the world were actually founded by the parent company, right? So company decides to expand its operations from Canada into the United States, it sets up an American subsidiary. So it owns 100% of it. In that case, there's no goodwill whatsoever. Basically, it is an extension of the company, so there's no concern about what the fair value of those net assets and so forth is that you have to worry about in a regular consolidation. The same thing if a company spins off a subsidiary that will own the intellectual property of the company, for instance, as Apple has done. That's completely owned by the parent company. So there's nothing to worry about in a consolidation. It's just a splintering of the assets and liabilities off into a separate legal entity, but the consolidated company is going to just add everything together. There won't be any consolidation issues there. Goodwill only arises as a residual in situations where the subsidiary was not founded by the parent company. So here's what happens. If the company does an acquisition of another company, goodwill arises by taking the purchase price that is paid for all of those assets and liabilities. Remember, when you buy another company, you're acquiring all of its assets and all of its liabilities. So the price that you pay to the shareholders of that company in order to take their shares from them and own them yourself, that's the purchase price that you negotiate with those shareholders. And what you acquire is the fair value of the assets and the fair value of the liabilities of that company. And that may not add up to the price that you paid to the shareholders. So you take the purchase price and you deduct from it the net assets of the acquired company at the fair value. So ignoring what that company's financial statement says, you have to determine what's the fair value of the assets that you got, what's the fair value of the liabilities that you got, and you deduct that net value from the purchase price, and you're left with the remainder. And that is what is goodwill. So that's the only circumstance in which goodwill arises on the financial statements of a company. Anytime that you see goodwill on the financial statements of a company, you know that at some point in the past, it purchased another company from the shareholders of that company, and it paid more for that company than the fair value of the net assets that it acquired. Why does it do this? Well, because it gains control over those assets, and it's worth paying to get that control. So keep in mind that the purchase price is a market price that's paid. You negotiate as a purchasing company, you negotiate with the shareholders what that purchase price is. And what you get is the assets and liabilities of that company. You have to determine the fair value of them, and the goodwill is the remainder. So this goodwill then is obviously an intangible asset. It is the difference between the purchase price that was paid and the actual assets that you received and the actual liabilities that you received. So it's surely an intangible asset. This is what the transactions look like when the acquisition takes place. The parent company on its balance sheet has a decrease in cash for whatever it paid to those shareholders of the other company, and it records a financial investment because it now owns shares. Right? So the parent company has a new financial asset that is shown at the value that is paid for it. And this is assuming, of course, that it's an arm's length transaction, that the price that was paid for it is a fair price. Obviously, if you purchased a subsidiary from somebody that you were related to, you might negotiate a price that is favorable to them or favorable to you, and the accounting considerations become a little more complex. So I'm only talking about a transaction that takes place at arm's length where you have no influence over the price. It's simply a fair price that's paid for the shares in that other company. So this is the parent company. And remember, the parent company is different from the consolidated financial statements. Right now, as soon as that transaction is done, you've got two sets of statements. You've got the parent company, which has had this transaction recorded on it, and you've got the subsidiary. Keep in mind that the subsidiary's financial statements are not affected in any way because the shares were purchased from the shareholders of that company. The subsidiary itself was not affected at all. So there's no effect on its financial statements at all. Those two financial statements, though, have to be consolidated together in order to represent the overall economic entity. So that's what we're going to look at now. Here's what a consolidation looks like at the balance sheet level. What you have is you've got the parent company's balance sheet, and you've got all of the assets and liabilities that it acquired off of the other company. So conceptually speaking, this is what happens. You've got the cash that appeared on the parent company's balance sheet, and you've got the fair value of the cash that was in the subsidiary. Now, the fair value of the cash and the actual value of the cash will be identical. But what you've got then is a total of, in this case, $3,000 worth of cash. The accounts receivable of the parent company is included in the accounts receivable of the consolidated company. And what happens is you look at the accounts receivable of that other company and estimate the fair value of it, and you add that to your own parent company accounts receivable, you get $38,000 in this situation. Same thing for the inventory. You figure out what the fair value of the inventory is, and you add it together. And the capital assets and the fair value of the subsidiary's assets, add those together. Do the same thing for accounts payable and for the debt of the company, right? So the company might owe some money. You have to figure out the fair value of that by taking the present value of all the future payments and so forth. So all of these are consolidating the assets and liabilities on a line-by-line basis. And there's two things that happen. You've got the parent company's balance sheet items at whatever value they are, and you've got the subsidiaries' balance sheet items at fair value. So this ignores the values that are shown on the subsidiaries' balance sheet. It's looking at the fair value of those. And then what you've got here is a slight reconciliation problem. On the parent company's balance sheet, you've got this investment in the subsidiary. And that investment in the subsidiary is $1 million in this case. And remember, we have to eliminate in the consolidation intercompany transactions or intercompany assets, intercompany liabilities. So that gets removed from the consolidated balance sheet. So that $1 million figure is canceled out and we end up with nothing there. And that gives us a difference then between the net fair value of all the assets right here and the $1 million investment. We need, in this case, a $794,000 figure to balance. So this is where the Goodwill line will then appear on the consolidated financial statements. So what does the overall financial statement look like then when you finish the consolidation? I'll show you. What happens is we want to erase basically all of this stuff that's in the middle, including this line here. So all of those columns are eliminated. We're even getting rid of all of this stuff here, okay? All of that is gone. And what you end up with then is that as your labels on the balance sheet and these as your numbers on the balance sheet. That's what the consolidated statement is going to look like. So when you see consolidated numbers and you see things like Goodwill, on the consolidated balance sheet. That's how that number was calculated. All right, so that's the conceptual view of the consolidation of a balance sheet. Think about it and try to keep in mind what is happening and where those numbers on the consolidated balance sheet come from. So let's talk about goodwill and how to account for that. The reason that goodwill arises is that the company that purchased the other company is willing to pay more than the fair value of the net assets of the company that it's acquiring. Why would it do that? Well, it's hoping that it's going to earn higher profits. So one of the things that happens is, for instance, it may have acquired a competitor. And without that competitor in the marketplace, the potential is there for the consolidated company to exercise influence over the prices because the people in the market that are buying those products and services don't have any alternative now. So it gives the company market power and can potentially produce higher profits in the future that way. Or it could be that it's not a direct competitor. It could be that this company is doing something else and the consolidated company is able to develop some synergies. So, for instance, a company that builds houses in the housing market might acquire an architecture firm and take advantage of the synergies between those two companies in order to generate higher profits. So that's why the acquiring company might be willing to pay more than the fair value of the net assets of that company, just in the hope that it's going to earn future profits. And then the other reasons for paying more than the fair value of the net assets would be what you acquire. So, for instance, you might buy a subsidiary that has a really great CFO. And rather than hiring them away, you might just purchase that other company and take on all of the experienced managers. That might be particularly important if you're buying a subsidiary that's in another region that you aren't really equipped to understand. So, for instance, if you're a company operating in Canada, say in Ontario, and you wanted to expand into Quebec, it might be really helpful to have some people who understand the laws and the economy and the customs of Quebec. So you would be well positioned if you were to purchase a Quebec company and retain the managers of that company onto your management team so that they can advise you on how to operate there. Same thing would happen if you were an American company deciding to expand into Japan. You might be better off purchasing a Japanese company in your industry in order to acquire their expertise in how to operate in Japan, and vice versa, of course, if you're a Japanese company expanding into the States. So the other thing that can happen then, rather than simply getting management capability, is you might just want to acquire a market position so you can rapidly establish yourself in another region of the globe or in another market that you're not in. Say you're a dairy company and you wanted to expand into the meat section of the grocery industry. You could acquire a company like, suppose you're Saputo and you wanted to expand, and you could buy Maple Leaf Foods, which does a lot of meats. And that way you've got a strategic advantage by acquiring people and a company that already operates in that sector of the grocery industry without having to invent a new company and go head to head with established competitors. And then finally, and this is not an exhaustive list, but a final example would be that you might want to acquire the customers and the reputation of that other company. So this is something that happens when you see a company like Procter and Gamble. When they purchase a subsidiary, they retain the brand of that company. They don't take it over and say, you're now Procter and Gamble. They stick with the brand that has been established by that company and continue to market under that brand because customers love that soap or that dishwasher detergent or those makeup products or whatever. So all of these are reasons why the company that is doing the acquiring might pay more than the fair value of the net assets of the subsidiary, because all of these are going to advantage it and they're worth paying for. How do you account for that goodwill once you've established the value of it? Well, it is an intangible asset. And in the olden days, and I believe still in the United Kingdom, for companies that don't follow IFRS, goodwill would be amortized over a period of time. Now, under IFRS, companies do not amortize their goodwill. What they do is they apply an impairment test each year. And if the investment that they've done in that other company is no longer paying off, then it should reduce the value of its assets. And the first thing to go is the goodwill. So in the previous example, we had $794,000 worth of goodwill. If the impairment test indicates that the investment in that other company should be written down by $100,000, we would reduce the goodwill from $794,000 down to $694,000, and all the other assets and liabilities that are recorded in the balance sheet at fair value would stay there. So, of course, if the impairment test shows that the value is still there in the company, you don't touch the goodwill, you just leave it alone. Those net assets might continue to grow and the goodwill will just sit there. The value of the inventory might go up, the value of the liabilities might go down as the mortgage is paid off, but the goodwill just sits there, it never goes up. But if the impairment test indicates that the overall value of the investment has gone down, you have to write it down. And so you're going to have a credit to goodwill because it's an asset, and the debit is going to go onto the income statement as an impairment loss of some value. When the impairment test indicates that the value of the investment has gone down even lower than goodwill, then all of the goodwill is going to disappear off the balance sheet for that investment. And at that point in time, you would then begin to reduce the fair value of those other assets. So as I say, the first thing to go in an impairment test is a goodwill. And it's only once the goodwill is gone completely from that investment that you look at changing the disclosed value of the other assets and liabilities that you own in that subsidiary. Let's return to the consolidation and look at the income statement. So we just finished looking at the consolidation of the balance sheet, and I showed you the example of consolidating on a line-by-line basis, taking the values that are shown on the parent company's assets and liabilities and adding to them the fair value of the subsidiaries' assets and liabilities, and ending up with goodwill. When you are looking at the income statement, you also do a consolidation and you do it on a line-by-line basis. The sales of the parent company and the sales of the subsidiary are added together. The SG&A of the parent company and the SG&A of the subsidiary are added together. The financial income or loss is added to the financial income or loss of the subsidiary, and so forth and so on a line-by-line basis. What gets eliminated is any transactions that happen between the parent company and the subsidiary. So if there was, an amount that was paid in a purchase from the parent company to the subsidiary, that would be canceled out because you've got an expense for the parent company and revenue for the subsidiary. They're going to cancel each other out. And vice versa. If there is a transaction that went the other way, those two things would cancel themselves out. What that allows you to do is make sure that you don't double count any profit of the two companies where the profit was recorded twice. Now, if you own less than 100% of the other company, but you've done a consolidation, then the other shareholders own a minority share in the net assets and in the net income. And as we saw, this is disclosed as minority interest or non-controlling interest on the balance sheet and on the income statement. In some circumstances, a company will disclose this minority or non-controlling interest in between the liability and the equity section as a figure that is just in limbo. And in the Saputo example that we saw, it shows at the bottom of the equity section. And the same thing on the income statement, it may appear just above the net income. As we saw in the Saputo statement, what they did was they calculated the total net income, and then they had another little section appended, which broke down the portion of the net income that pertained to the shareholders of Saputo and the portion that pertained to the non-controlling interest and the total which matched the net income. So those are varieties of ways in which that could be disclosed. Just pay attention to that and you'll be able to see what that means. It's just the portion of the net assets or the net income that has been consolidated into the balance sheet and the income statement of the consolidated company, but which actually pertain to those shareholders that hold a minority position in the subsidiary. Well, that was a long-winded explanation. Let's try and take stock of what we've learned. We looked at investments in other companies. Investments in other companies depend on the degree of influence that you have over the other company. If you've got control over the other company, between 50 and 100% of the shares, then you are supposed to consolidate. If you've got less than 50%, but still a significant stake, then you have what's called significant influence and you use the equity method. And if you have just a small passive investment in the other company and don't exercise any undue influence, then you've got all of the methods of accounting for the passive investment that we talked about: amortized cost, fair value for the P&L, which is the default category, and fair value through OCI. And then we also talked about consolidations in a little bit more detail. Again, the purpose is not to turn you into an expert on how to do all those calculations. Is to make sure that you understand them so that if someone were to put a set of financial statements in front of you and say, what's that mean? Then you should be able to explain it. That can happen on your first day of work. It can also happen on the final exam.
Well, it's all about money, money, money. Ooh.